So today we are going to be looking at capital budgeting decision, and this topic will take us for the next minimum of 3 periods. So let's see what we can achieve today and subsequently. Okay, without wasting more time on the topic, capital budgeting is a very important topic in strategic financial management. In fact, I can say it's a center of discussion when it has to do with investing decision. You know, there are 3 principal decision areas in finance, where there's investing decision, dividend decision, and then financing decision. So the investing decision is very important. And one of the the main purpose of carrying out investing decision is to ascertain the financial viability of a project, because the limited scarce financial resources of a company is not sufficient. Therefore, the management of a company would desire to judiciously utilize the available scarce resources among competing investment, if any, okay, in order to ensure that optimal use of resources are ascertained, all right? And then again, the primary purpose of any business organization is to be able to create value. When a company makes profits, of course, it means that profits will surely enhance the owner's equity value. So when there's project opportunity, okay, when there's investment opportunity, it is not sufficient for the company to just commit the hardened financial resources into executing the project. So a careful and critical examination and as well as evaluation will need to be carried out on the project before money is being spent. Therefore, and that is what inform what we're about to be to discuss. Okay, so today purely our discussion will center around the concepts, the underlying concepts in capital budgeting. Therefore, what do you then understand by capital budgeting? So, of course, when you say capital budgeting, it's the same thing as capital investments, it's the same thing as investment appraisal, okay? So, it involves the process by which an organization commits its funds into long-term projects, okay? When you say long-term projects are projects that span over one accounting period. Any project that will last for more than 1 year, they are capital projects, okay? They are capital projects. Examples include the construction of roads, dams, office building, refinery, bridges, and stuff like that. You can imagine the level of investments that Dangote refinery is having on the Lekki axis in Lagos State. These are the things, these are the kind of investment that we are talking about. You can imagine the level of investments when the last administration of Buhari completed the Niger Bridge, or what do you call it, between the east and the south, you know? So you can imagine the level of investments if the federal government wants to reconstruct the kind of 10 million bridge that you have in Lagos today, you know? So these are the kind of things you have. In fact, even if it's owner-occupier building, your own building that you want to construct, it will surely last for more than 1 year for you to complete, okay, for you to complete the project. So these are the things that we want to be looking at, all right? Because when you want to invest in this kind of a project, it is important to carry out the financial analysis. You need to appraise, you need to evaluate the project to be sure that optimal use of resources is achieved. Because The primary responsibility of any management of a company is to create value for the business. And in creating the value for the business, you must embark on any projects that will increase the value of the company, which will invariably maximize the wealth of the owners. Because if a management cannot maximize the wealth of the owners, what that means the management does not have responsibility of being there. Okay, there is no point of having some people to manage your business on your behalf if they cannot create value. All right. So as a result, once there's any investment opportunities, there will be need to appraise the project in order to ensure that the project is financially viable to be able to, in order to create value for the business. Okay. So that is that. Then what are the procedures? What are the procedures involved in capital budgeting decision? Okay, there are about 6 procedures, key 6 procedures that a company may likely may carry out when undertaking capital budgeting decision. Number 1 is to identify viable investment opportunity. Okay, identify viable investment opportunity or portfolio of projects. Now, the identification of investment opportunity is major responsibility of marketing or research and development unit of an organization, depending on the size of the company. Okay, depending on the size of the organization. So they are the one that is that will scan the business environment to be able to identify that investable opportunity. Once any opportunity is available, they will need to communicate to the management of their findings. A whole lot of activities will go into that. I don't want to dwell too much on that because at this stage, this examiner cannot be asking you to be what are the procedures, explain the procedure involved in capital budgeting decision. But that notwithstanding, it's good to know. All right, it's good to know. So, like I said, in the first step, there are a whole lot of activities that will go into that. But the bottom line is that as once that opportunity is is identified, the responsible party or the responsible person within the organization will need to communicate to the management. First thing first, they will have a meeting to discuss their findings, and then, of course, it will also be documented through memo to say, okay, this is what we have done, this is our findings and all of that. So it is from that meeting, another unit of the organization will need to be we will be given the another exercise to go ahead and appraise the project. And this is where you have responsibility, because the finance department, which is headed by the either finance director, chief financial officer, finance managers, and finance, whatever the depending on the size of the organization. So the finance department is the one that will be responsible to appraise the project, to evaluate the project in order to ascertain its financial viability. Okay, so once the project has been appraised, that is step 2. That is step 2 is the project evaluation. So once the project has been appraised and it is good to go, then again, the finance director or the CFO or the finance manager of the company, which in the first place was asked to go and determine the financial viability, we need to get back to the management. Again, a meeting will be held to discuss the recommendation, the suggestions, or the advice of the analysis from the finance director based on the analysis carried out. So if the project is financially viable, then management will give it a good to go. But if the project is not viable, of course, the recommendation from the finance department or from the finance director will be that the project should not be undertaken. But however, if the project is financially viable, then it means that of course, the company will need to undertake the project. So which will now take us to the 3rd procedure. The 3rd procedure is authorization and approval of project. So because the project is financially viable, the management will be willing and ready to commit its financial resources into the project, since the person that is endowed with requisite knowledge and expertise, as per the evaluation of the project, has confirmed that the project is good to go, then of course management has no choice than to just approve and let the project begin. Okay, and let the project begin. However, there are another thing we need to happen, because the project can only commence, the construction of project can only commence if and only if the company have sufficient resources, man and material, okay, including money, to execute the project. So if the finance is not available, of course, that will take out, and that's another thing entirely. Remember, I told you earlier today, there are three core principal areas in finance: investing decision, financing decision, and dividend decision. So if there is no money available to execute the project, so the company will need to identify, or we need to ascertain how the project will be financed. Are they going to borrow money? Are they going to request or ask the shareholders to contribute more for them to be able to execute the project? Okay, all of this is another things entirely when it comes to financing, but our focus is on investing. So let's move on with that. So after step 3, like I said, step 3 is authorization and approval of project. So step 4, because there is a management approval, then we need to go to step 4. Step 4 is developing and execution of projects. Okay, we have already sought, we've gotten management approval. So that means there is an authorization to spend money. So once that is done, then we need to mobilize people and equipment to site. So in this step 4, of course, in step 1, a whole lot of, like I mentioned the other time, a whole lot of activity will go into that. Okay, so because depending on the size of the company, there will be a capital budgeting committee embedded within the organization that will review vendors or contractors quotation and all of that. So many, depending on the policy of the company. Maybe it's going to be single sourcing, or different contractors or vendors will be asked to come and submit their bids and all of that, or quotation. So, but again, I don't want to go into all of those practical details. But the bottom line is that once in that step 4, which we said execution and developing of a project, so it is at that point you mobilize people and equipment to site. Before that day, you would have, the company would have agreed on the contractor, and they would have selected and agreed on the contractor that will do the job. So it is once there is those at that point that they are just waiting for management approval. So once the management approval is available, then what is next is for the company to just mobilize people and equipment to sites. That means the work has begun. All right. So the contractors will mobilize his own people, including equipment. Then construction has begun. From that point, of course, depending on the duration of the project, it could be 2 years, it could be 3 years, it could be 4 years, it could be 5, it could be 10 years, whatever the duration of the project. Of course, all of this would have been determined from the beginning, okay, before construction will begin. All right. All the safety issues, everything that has to do with the projects, the people, the equipment, everything will be detailed in the contract agreement between the two parties, between the contractors and the company. But again, these are practical things. A whole lot of activity will go into that, but that's not our focus for today. Now, after mobilizing and the execution of projects, that will take us to the next step, which is step 5, monitoring and controlling of projects. So at this level and at this stage, it's not sufficient for the company to just commit its funds into executing the project. The company must also go further by ensuring that judicious use of the scarce financial resources is achieved. So the company must ensure that there is value for money. They are getting value for the money they are spending on the project. Therefore, they must monitor the activity. Okay, monitor the activity of the people and equipment on site. Contractors have said that they have quoted in their bid. They have also expressly stated in the contract agreement that they have so much responsibility. How does the company ensure that the contractor abide with the rules, okay, with the dictates of the contract, okay? So at this stage, the company will need to ensure that his own representative are present on site to ensure that the right quality and quantity of materials are being used, so that, because mostly contractor will want to increase his or her own margin. The contractor will want to increase his own margin. So as a result, they may want to cut to follow shortcuts, so that in order to increase the margin and make so much profit at the end of the day. So it is the company that will now decide that, okay, because my reputation as a company is at stake. If I don't monitor the activity of these people on site, I may incur financial losses, a whole lot of risk. There are a whole lot of risk that are in.
Please block him.
There are a whole lot of risks that are involved in project activity. So all of this will need to be monitored. Uh, we need to be monitored, giving close monitoring on a regular basis. So if the contractor has quoted that they are going to use, say, for example, 10,000 bags of cement, how do you ensure that they are using the same quality and quantity of the material they've quoted? Because like I mentioned the other time, they will always want to increase their own margin. Look at what happened last time I think it was 2022, the Ikoyi Gate in Lagos, the 21-story building that collapsed in 2021. Yeah, 2022. I think it's around February, or I can't remember the exact date. Almost about 50 people died under the construction activity that were going on then, including the owners of the business, the NYC that are on site, so many different categories of people died in that incident. Okay, why did that happen? Government of Lagos State gave an approval for 15 floors, okay, for 15 floor high-rise building. And the contractor, the owner of the building, went ahead and increased it to 21, So you can imagine, if the owner of that building was to be alive today, where will he be? How will he be able to face the family of those people that lost their lives? So these are the things we are talking about. So yeah, as a responsible organization, as a responsible management, you must ensure and work tirelessly to protect the corporate image of your company, in order to ensure that any casualty or any appearance or anything that can impair the reputation of the company is avoided. So you can imagine, how would the owner of that building that collapsed in that 2022, how will he face the people? How will he face the media? How will he face the government if he were to be alive? So this is the thing we are talking about. So you must monitor the activity of people and equipment on site. If the contractor has said that they want to use scaffolding as part of the thing they've quoted in the contract, you must ensure as a responsible company that they are using scaffolding. Because if contractor is quoted for scaffolding, they may decide to be using ladder in order to save cost. So anything can happen. But when you have your own people present on site to monitor the activity, to monitor the construction activity that are going on, of course, there will be risk, but the risk will still be minimal. And then again, the presence will deter the contractor from cutting corners. Okay, so these are the things. Not only monitoring the activity and people and equipment on site, you also need to control costs, because the financial resources is limited, it's scarce, it's not sufficient. So the little you have, you need to judiciously and efficiently manage it by ensuring that if when you have a project activity like that, you must have a budget. Okay, maybe the project duration is about 5 years. So, and the cost of the project, say for example, is 5 billion naira. So you need to, okay, on each year, because it's the activity of the project that will be driving the cost you are going to spend for each year. So they would have determined the duration of the project and the activity for each period. So, and then of course, value will be attached to each activity. Then you need to monitor, you need to ensure that what is being spent is what is being budgeted for. Okay, So you are going to have, this is also where you have responsibility as a finance person, whether you're a finance analyst or you're a financial accountant or you're a project accountant or you're a business, finance supervisor, finance manager, or that is all of you within your department, within finance department or accounting department. This is where you also have responsibility by preparing on a monthly basis. You need to prepare the project report. Okay, you call it, depending on the organization, it could be called a stewardship report on the project. So that will show, okay, what is being budgeted for. It may well be that you have more than one project that you are executing. So you need to establish what is the budget, what has been budgeted, how much is being budgeted on this project, what is the spend to date, how much do you forecast to spend for the next period and all of that. So because if you don't monitor the costs, when you don't monitor the spend activities, there is likelihood for you to go above your budget. And that's why it is important at all times you need to monitor the activities and you need to monitor your spend. When, as a finance person, once your spend is almost getting to the budget, to the limit you are supposed to spend for that particular year, then you need to inform the money, because on a regular basis, it should be management should be informed on the project activity, especially the spend, because again, you'll be relating with other project teams from time to time, the project manager, the project supervisor, the project controller, so many kind of people, engineers, that you, an accountant or finance person, that will be relating with on a daily basis as far as the project is concerned in practice, okay? So, but the bottom line is that as far as controlling of project is concerned, the essence is to ensure that the project, you don't go above the limit. Please always mute yourself. It's very distracting. Please. So you need to ensure that you don't go above your budget. So if at all you want to go above the budget based on prevailing market condition or work environment, if you want to go above your budget, then you need to inform management as quickly as possible so that they are aware and they prepare for it. Because at times it is possible the prevailing market economic condition may warrant for additional costs to be spent. Say, for example, if there's an extension of time, like what happened in 2020 during the lockdown, during COVID-19, people could not work in the office. People could not do business as they normally do, okay? So if you are having a project activity that are ongoing during that period, and you cannot access the site, you can't go to the site location and all of that. Of course, there may likely be an extension of time due to that COVID-19 that prevents people from working, okay? So there may be extension of time, and anytime there's an extension of time, there will be a possibility of additional costs that may be incurred, because contractor will tell you that I have people, I have equipment on site, and this equipment I'm paying interest on a regular basis and all of that. Since I've not been able to, and then because of this, we'll not be able to work. As a result, we need to extend for the next 3 months, for the next 6 months, for the next 1 year, whatever the extension of time that will be granted. So whenever there's an extension of time, of course, money will be involved as well. Not only that, you can also, at times, you can also go above your budget, or you may shoot your budget because of, or they can even spend below your budget if there's a change in scope. For example, something that is not within the budget before, they are now introducing it, maybe because of there's an additional, there is a technological innovation that is, that the management think that they can embed on the project. So as a result, something that was not in the project before, you are now introducing it. Once that happens, there will be additional costs that will be incurred. Another way of changing scope is that, okay, something you have included in the project before that you want to do, due to one reason or the other, management may decide that, okay, that thing is not necessary again. If it is not necessary again, then that will reduce the cost they are going to spend on the project. Okay, that will reduce, because you are removing a particular scope, you are taking it out. So that will result to savings. Okay, a whole lot of things will make the budget to be, that will make the actual spending to be different from the budget. But the bottom line is that on a regular basis, you are going to, as you are working on the report, you'll be relating with the project team to ensure that management is well informed. Okay, management is well informed, because whether you are below budget or you are above budget, at all times you must provide justification by meeting with the project team. Why are we spending money? Why is our spending higher than what we budgeted? They will give you the details. Okay, they will tell you the reason, what is driving the increase or the decrease. So if you are spending below, they can tell, oh, it's because there's a change in scope. If they are increasing if the cost is higher than what you budgeted for, they will tell you, oh, it's because of extension of time or because of additional equipment that was bought. So many things can cause to vary relative to the budget. So these are the areas that you have responsibility as a finance person, okay, in your department. Then finally, the last one, which is step 6, is a post-completion investigation or audit. Okay, after the project has been completed, management may desire to know whether the objective at which the project is being executed has been achieved. Okay, not only that, during the execution of the project, okay, there will be lessons learned. Okay, project manager should not be scolded for any mistake or error committed during the execution of the project. So those lessons learned will need to be documented. The lessons learned will need to be documented so that when you want to undertake similar projects in the future, you can easily fall back to those learnings, and so that you don't repeat similar mistake. Okay, because every organization is in a learning process, and then at all time, those learnings must be documented. You don't just get, because it may well be that even the project manager is no more within the organization, or he has been reassigned to another role. But if it has been documented, you can always access the information and learn about the past experience of those project team and all of that. So these are the procedures in relation to capital budgeting. So that will take us to the next area that we need to discuss, which is characteristics of capital budgeting. I don't really like to talk about this because it's a waste of time. Again, let me just brief you on the characteristics.
Please, I have a question.
Talk to me. Talk to me.
Please. So, the last time you came, we were going to, I don't know whether we were planning to start, or we had just started specific cost of capital. I think
Project
specific project cost of capital. You gave us a question that I thought you were planning to solve with us, except you expect us to go and study it on our own. You sent something on Kilimanjaro or so.
Yeah.
We haven't finished that topic. You were supposed to take it in the last class that you could not, you couldn't make.
Yeah, I understand. I wanted to
combine
solve it.
Everything now.
No, hold on. I wanted to solve it. I wanted to solve it on that day. That was what I shared with. We have solved the one of Ferrari. So, and I wanted to have an additional one with you. However, what I intend to do now is that I will give it to you as an assignment. Then, if not, then after that, then we'll now solve the solution in class. But for now, but we have done Wakuka, right? Hello, Mr. Roberts.
Sorry, we did the weighted average cost of capital. We did that.
Of course, no, I mean weighted average cost of capital of combined activity.
No, we've not.
Oh, okay. You guys should have called my attention since now. No worries. Okay, let's what I will do is that let's continue. Okay. So please remember, once it's about 30 minutes to the end of today's class, let me know. Okay.
Okay, thanks.
Yeah. Thank you for that reminder. So you can go to the material and read all what I've been discussing since. So under the characteristics, again, I don't want to comment on this. It's a waste of time. So you can just read it through. At this level, the examiner cannot be asking you what are the characteristics of capital budgeting. In case you are asked, just say that it's involved huge capital outlay. Number two, it involves irreversible decision. It is considered to be very risky. The benefit will accrue over a long period of time. You can't do more than that. So just go ahead and read it through. Now, the major work, where we have major work under this topic, is the project evaluation, methods of project evaluation. That's the next thing we want to do. Okay, that's the next thing we want to do. What do you mean? What are the methods of project evaluation? Remember, I told you the other time, the examiner can also ask you this: why is investing decision important? Why is investing decision important? So the primary purpose of making investing decision is to ascertain the financial viability of the project. Okay, that's the primary purpose. You want to know whether the project is financially viable. All right. So in doing this, there are several techniques that you can use to appraise the project. And that's why we are going to the next one, which I call methods of project evaluation. So basically, there are two methods of investment appraisal or two methods of project evaluation. Number one is discounted cash flow method. Then number two, non-discounted cash flow method. So the discounted cash flow method is a method that takes into consideration the timing of cash flow and the time value of money. Okay, I check it again. The discounted cash flow method is a method that considers timing of cash flow and the time value of money. So the time value of money connotes that the value of 1 naira of today is worth more than the value of 1 naira of tomorrow due to price level changes and the investors' preference to have their benefits now rather than keeping it into the future. As a result of inflation, the purchasing power of money will fall. Therefore, investors, they prefer to have their money, their benefits now, rather than delaying it into the future. So you need to discount the future expected cash flow to its present value equivalent. So that is why it is called discounted cash flow method. Now, what are the techniques under discounted cash flow method? So we are going to talk about net present value. We'll talk about internal rate of return. We're going to talk about modified internal rate of return. Not only that, we also talk about project duration, profitability index, benefit cost ratio, adjusted present value. So these are some of the techniques under discounted cash flow method. Then the second method of project evaluation is non-discounted cash flow method, which is a method that does not consider timing of cash flow and the time value of money. It is also known as traditional method or conventional method of investment appraisal. And there are two key techniques. Okay, there are two techniques under the non-discounted cash flow method, including one, payback period, then two, accounting rate of return. All of these techniques are what we are going to be discussing next. Okay, so we need to be explaining each of them one after the other, one after the other. All right, so let's start with discounted cash flow techniques. So we start with the net present value. What do you mean by net present value? What is net present value? The net present value represents the difference between the present value of cash inflow and present value of cash outflow in capital investments. Okay, it represents the difference between the present value of cash inflow and present value of cash outflow in capital investments. So the NPV is considered as the overall, or is adjudged to be the overall investment appraisal technique, because it is a technique that is consistent with the shareholders' wealth maximization objective. Okay, so when you are considering the acceptability of a project, when having different investment appraisal technique, the NPV is seen to be the overall of all the investment in theory. Okay, in theory, NPV is considered to be the overall investment appraisal technique because it is consistent with the shareholders' wealth maximization objective. It is believed that a positive NPV will increase the value of the company and which will invariably maximize the shareholders' equity value, okay? Which will invariably maximize the shareholders' equity value. So that's one of the reasons why NPV is considered as the best, as the overall, okay? So you can read advantages and disadvantages, not at this level. Examiner cannot be asking you at this professional level to be stating advantages and disadvantages. So now, that is for NPV. How do you then calculate NPV? You can either use formula to calculate NPV or you use tabular method to calculate the NPV, okay? However, of course, based on what we have done so far under cost of capital, we have also calculated NPV using the tabular form, using this kind of a format. So you're already familiar with this. It's not something we can waste our time on, okay? So the bottom line is that you need to make a decision when you compute your NPV. When you calculate NPV, about again, for the benefit of those, maybe you miss our class on under cost of capital. So when you want to calculate NPV using this tabular method, of course, you create about 5 columns that you have here, as I'm showing on the screen. The first column will be for the year, okay? The description of items, the cash flows, okay? The discount factor, and at the same time, the present value. Remember, I mentioned earlier on when I was defining NPV to say that NPV is the difference between the present value of cash inflow and present value of our cash outflow. So you need to discount the future cash flow. These are the future cash flows. So you need to discount them to the present value equivalent. Therefore, what I need to do is to go and calculate my discount factor. So I will multiply the discount factor with the future cash flows. Whatever I have will be my present value. Again, for year one, for example, we have cash inflow of 550. The discount factor at 10% for year one is 0.909. When you multiply with that, that will give you 500. Again, in year two, discount factor at 10% for year two is 0.826. Multiply with 615. That will give you 508. So when you want to compute your NPV, you must start from the positive present value. You have to start from the positive present value. So you add up the positive present value, you net off the negative present value. So the difference will give you the NPV. So if your NPV is positive, we are going to the decision rule now. Okay, for the decision rule, for independent projects, you are going to accept if the project has a positive NPV. Like in this case, our NPV is 8. 8 is a positive present value, so a positive NPV. Therefore, the project is financially viable. That 8 you are seeing there, as little as it is showing that the project is viable. So the company can undertake the project. That's the interpretation. So once the project has a positive NPV, it means that the project should be accepted. But if negative NPV, the project should not be considered. But where there is zero NPV, then the company will need to take into consideration other qualitative factor. Okay. All right then. Now, but where you have mutually exclusive projects, when there's mutually exclusive projects, you are going to accept any project with a higher positive NPV. You have project A, you also have project B. So any of the two projects that has a higher positive NPV will be undertaken. All right. So that is that. That's the decision rule under net present value. Now, you need to understand what is independent projects, what's mutually exclusive project. Examiner can ask you. Okay, they've done it in the past, so they can ask you again. What do you mean by independent projects? Independent projects is a standalone project that may be accepted or rejected based on its own merits. I repeat, independent projects is a standalone project that may be accepted or rejected based on its own merit. Say, for example, now, in this hypothetical table that you have here, where you have this NPV. This is only one project. It's a standalone. So because this project has a positive NPV of 8, then we are saying that the project should be accepted. Okay, the project should be accepted. But if this project generates negative NPV, the project should be rejected. That is a standalone project. So again, what do you mean by mutually exclusive projects? A mutually exclusive projects are competing projects in which the acceptance of one will preclude the acceptance of the other. Like I mentioned, here we have project A, we also have project B. Okay, there's project A, there's also project B, for example. So if the company decides to accept project A, that means project B will be rejected. If the company accepts project B, project A will be rejected. So mutually exclusive projects are projects that cannot be accepted together. Only one of them will be accepted because the two of them are competing for the financial resources of the company, but the company does not have sufficient resources to undertake the two. Anyone that the company favor, okay, that has a higher NPV is the one that will be selected. So that is mutually exclusive. In case you are asked, just say mutually exclusive projects are projects that cannot be accepted together. Okay, they are competing projects in which the acceptance of one will prevent the acceptance of the other. All right. So those are the discussions under net present value. Okay. All right. So let's talk about internal rate of return. Let's talk about internal rate of return. What do you understand by internal rate of return? Simply put, the internal rate of return is also known as break-even rates, market discount rates, yield to maturity. Okay, yield to maturity. It is the rate that equates the present value, the net present value of the expected future cash flow to zero. That is, say for example, let me explain that concept. We are saying that internal rate of return is the rate that equates NPV of the future expected cash flow to zero. Now, say we have assumed 10%. For example, we assume this 10% and we use the 10% to calculate our NPV. And the result we have here as our NPV is equal to 0. We assume 10% and this 10% produce 0 NPV. Therefore, that rate that you assume that gives a 0 NPV is the internal rate of return. So that's why we are saying that internal rate of return is the rate that equates the NPV of the future expected cash flow to 0. So that is for that. And then the internal rate of return rely heavily on the trial and error method of interpolation. It relies heavily on trial and error method. So there is no specific way of calculating internal rate of return. And that's why one of the disadvantages of IRR is that it is subjective. Okay, it is subjective because you are the one that will assume the discount rate that you are going to use to discount the future cash flows. So there are 3 procedures you are expected to carry out whenever you want to calculate internal rate of return. The first procedure is to assume 2 discount rates that will produce 2 opposing NPV. I repeat, the first step in calculating internal rate of return is to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will produce positive NPV, another discount rate will produce a negative NPV. Then proceed to step 2. Step 2 is to calculate internal rate of return using the IRR formula. Okay, we calculate internal rate of return using the IRR formula like this. Okay, A is the lower discount rate, B is the higher discount rate. All right. Then step 3, you need to advise on the acceptability of the project. So that will take us to the next step, which is a decision rule. Please, once again, if I'm too fast, let me know. Again, you have done this at case level, so we're just refreshing. All right, we're just refreshing. So you can just on your own, you can go through the advantages and disadvantages of IRR. So now let's talk about the decision rule as well. For independent projects, you accept you accept the project if IRR is greater than the company cost of capital. So when you want to make a decision on the acceptability of a project using IRR, your calculated IRR must be benchmarked against the company cost of capital. So that's the concept. When you want to make a decision using IRR, you are going to compare your calculated IRR with the company cost of capital. So for independent projects, if your calculated IRR is greater than the company cost of capital, then the project should be accepted. If not, the project will be rejected. That is for independent projects. However, for mutually exclusive projects, you will accept any project with a higher IRR, provided it is greater than the company cost of capital. Okay, that's the decision rule for mutually exclusive projects. At this point, let me hear from you if you have any question for me before we proceed. Any questions so far? Okay, so let's move on. The next thing we want to discuss is the area of conflicts between net present value and then the internal rate of return. Areas of conflicts between net present value and the internal rate of return. What is causing the conflicts? How can you resolve the conflicts? Let's discuss it. When there are mutually exclusive projects, remember I told you earlier today that mutually exclusive projects are competing projects in which the acceptance of one will preclude the acceptance of the other. So when there are mutually exclusive projects, the decision of NPV may be conflicting with the decision of internal rate of return. NPV criterion may favor a particular project, and then the IRR we consider another project. So this is an apparent conflict. Therefore, examiner can ask you, what are the reasons for conflict? What are the reasons or causes of conflict between NPV and IRR? Okay, and IRR. There are three key reasons for conflict between NPV and IRR. I will use hypothetical numbers. Let me look for space so that the thing can sync. Let me use hypothetical numbers. Say, for example, we have two mutually exclusive projects, project A. We also have project B. The initial outlay of project A is 500 million. Okay. Project B is 800 million. Let's say we have discount factor here. For example, the one that is common, 10%. All right. Then the useful life of project A, we have the cash flow of project A in year one, say for example, is 300 million. In year two, 250. In year three, 100. Year four, dash. Then project B, say you have 100 in the first year, followed by 150 in the second year, 300 in the third year, 350 in the fourth year. Then let me make this one to be 250, 250, 300 for simplicity. Then in year five, we have 350. So these are the cash inflows. Now, and you know that discount factor at 10%, for example, for year zero is 1. For year one, 0.909. 0.826 for year 2, 0.751 for year 3, 0.683 for year 4, and then 0.621 for year 5. So these are hypothetical number we want to use to explain what is causing conflicts between NPV and then the internal rate of return. So the number one area of conflict between NPV and then internal rate of return is where there is significant difference in the amount of capital outlay. So, like I said, where there is significant difference between the amount of capital outlay of the two projects. As you can see from this hypothetical number, the initial outlay of project A is 500 million, while that of project B is 800 million. As a result of the marginal difference between the two, 500 and 800, there will be, the two of them cannot produce the same NPV. They cannot produce the same internal rate of return because there is a significant difference in the amount of capital outlay. With 500 and 800, that's a difference of 300 million. So as a result, there may be conflict between decision of NPV and decision of internal rate of. Just in case you are asked, that's what I'm taking my time to explain this. Examiner can ask you to discuss or to explain the causes of conflict between NPV and then internal rate of return. These are and how to resolve the conflicts. So these are the reasons why I'm taking my time to explain this. Then the second reason or causes is difference in patterns of cash flows, difference in patterns of cash inflows. When you look at project A has a higher or a huge cash inflow at the earlier part, and then a smaller one at the latter part of the project. Whereas project B has a smaller cash inflow at the earlier part, and then a huge sum of money, a huge cash inflow at the latter part of the project. Therefore, project A that has a higher cash inflow in year 1, for example, relative to project B may be favored, because when you look at the discount factor at the earlier stage of the project is usually higher than the latter part. So meaning that any project with a higher cash inflow at the earlier part may be favored relative to the project with a lower cash inflow. So that is what I'm trying to say as difference in pattern of cash inflow. Okay. Please give me 1 minute. So when you look at the pattern of project A, which has a higher cash inflow and the earlier parts relative to project B that has a lower cash inflow at the earlier part of the project. So project A may be favored over project B because the discount factor at the earlier part is also very high. So that is what we simply mean by a difference in patterns of cash inflow between the two projects. Then the third one is difference in project sizes or useful life of the project. For example, when you look at these hypothetical numbers, we notice that project A has 3 years life. Project A has 3 years life, whereas project B has 5 years life. Project B with a higher, with a higher useful life may be favored over project B, over project A. So as a result, the decision of NPV may be conflicting with the decision of internal rate of return. So these are the 3 key reasons or causes of conflicts between NPV and then the internal rate of return. Now, examiner can ask you, how do you resolve the conflict between NPV as well as the internal rate of return? These are the things I just discussed, so you can just go through it to have more knowledge on that. Now, how do you resolve the conflict between NPV and then the internal rate of return? When you have a choice, when you want to make a selection between mutually exclusive projects. Okay, so at all time, your decision should be based on the net present value, because NPV is a technique that is consistent with the shareholders' wealth maximization objective, because it is believed that a positive NPV will increase the value of the company, and which will invariably maximize the wealth of the owners. So, and that's why NPV is favored over internal rate of return or any other technique. So at all time, except the examiner says otherwise, when you are given, when you are asked to calculate, when you are asked to appraise a project using several techniques, an examiner is now asking you thereafter to advise on the on the project, on whether they should undertake the project. So, for example, you have calculated, you use NPV, you use internal rate of return, payback period, all of those techniques, and you are now asked to advise on whether the project should be undertaken. So what we are saying here is that at all time, your decision should be based on the net present value. Your decision should be based on net present value, because NPV is a technique that is consistent with the shareholders' wealth maximization objective. So in this case, all you need to do is to justify the reason why you are selecting NPV, why you base your decision on NPV, and then you negate through the disadvantages of other technique and the reason why you should not accept the project on the basis of those other techniques. For example, if it is internal rate of return, we can say that, for example, you can say that the NPV has been used to advise on the acceptability of this project, because NPV is a technique that is consistent with the shareholders' wealth maximization objective. A positive NPV will increase the value of the company, and which will invariably maximize the wealth of the owners. However, the internal rate of return is not considered because it's subjective. Just look for something, one of the disadvantages of IRR, for example, and say that is the reason why you did not choose it. So when you favor NPV, you need to negate the other one to justify your position. So these are the things you need to take into consideration as far as the areas of conflicts between NPV and IRR is concerned. Okay, so that is basically that. So far, so good. Under cost of capital, we have calculated NPV. We've also calculated the internal rate of return. However, so what we are doing currently is to explain the concept. Okay, what we are doing is to explain the concept. No calculation. We are going to do our calculation separate. Yes, calculation is for about 2 periods. Okay, 2 different periods we are going to use for, but for now, you need to understand the concept. And the good thing about this is that you have covered about 40% of the explanation under, in fact, even more than 50% of the concept of capital budgeting under performance management. But again, I want you to assume zero knowledge. So that's why I'm taking my time to explain things to you again. All right. So let's talk about modified internal rate of return. Remember, I told you I listed the techniques under discounted cash flow method. So we have talked about NPV, we have talked about internal rate of return. Now let's talk about modified internal rate of return. What do you mean by modified internal rate of return? When there are unconventional cash flows, okay? Unconventional cash flow are those cash flows that have positive and negative numbers. Say, for example, in year 1, you have a cash flow of 1,000. In year 2, you have a negative cash flow of 200. In year 3, you have cash inflow of 300 or 400. In year 4, you have cash flow of 100, for example. So when you have cash flow that has both positive and negative, okay, you have cash inflow and cash outflow. So in between years. So that is unconventional. So when there are unconventional cash flow, it is not appropriate to use internal rate of return as a decision-making criterion because it will conflict with the decision of NPV. It will conflict with the decision of NPV and therefore will not be consistent with the shareholders' wealth maximization objective. So generally, all our assumptions so far as NPV is concerned, is that the cash flow to be generated by the project will be can be reinvested at the company cost of capital. Okay, the assumption behind NPV is that the cash flow to be generated by the project will be reinvested at the company's cost of capital. Whereas the internal rate of return is saying that no, cash flow generated by the project should be reinvested at internal rate of return. Again, this is an abnormality. So as a result of this apparent conflict, the modified internal rate of return is being developed. Therefore, the modified internal rate of return is a kind of technique that can specify the reinvestment rates or the cost or the discount rate to be used to appraise or to discount the cash flow to be generated by the project. Okay, so that's that. Then, how do you calculate modified internal rate of return? How do you calculate modified internal rate of return? Now, when you want to calculate modified internal rate of return, you can either use present value method or you use terminal value method. Whichever one you use, you are going to get the same answer. I repeat, when you want to calculate modified internal rate of return, you can either use present value method or you use terminal value method. So when you want to use present value method, on the day of your exam, it is the present value formula that the examiner will give to you at the back of your question paper. Okay, this is the big for nothing formula. This one is the big for nothing formula that I called present value method. So in this case, when you want to use present value method to calculate your modified internal rate of return, the first thing you need to do is to calculate the present value of cash inflow separate. You also calculate the present value of cash outflow separate. Then you now come and put it in this formula. You are good to go. At the back of the question paper, you are going to see PV of return phase, then PV of development phase or investment phase. Okay, so when the company is pumping money, spending money on the project, that is the development or investment phase of the project. The company is spending money, so that's the PV of cash outflow. After the completion of the project, it is expected that the project will begin to generate cash flows. So that cash inflow is the return phase of the project. That's the return phase of the project. Therefore, the present value of cash inflow or return phase cash flow divided by the present value of investment phase or cash outflow, okay, raised to power 1 over n. N is the useful life of the project. N is the useful life of the project. Then multiply by 1 plus the cost of capital. Everything then minus 1. So that will give you the modified internal rate of return. So when you are calculating this big for nothing formula, okay, this big for nothing formula is mostly suitable. It's mostly suitable if in the question you have been asked to calculate net present value, and then you are now asked to calculate the modified internal rate of return. So it will be quicker for you. Instead of using terminal value, just use the present value method and you are good to go. Because you've already computed your NPV. Just add the NPV to the what's it called? The present value of cash outflow. Okay, you add the two of them together, that will give you your total present value. Once you have your total present value, then you just divide it with the present value of cash outflow, put in all the other variables, you are good to go. All right. So that is what you need to do under using present value method. Now, using terminal value method, there are some things you need to carry out before you can use this formula to calculate your modified internal rate of return. You need to go ahead and calculate the terminal value. So the terminal value is computed only for positive cash flows. You calculate terminal values for positive cash flows. You don't calculate terminal value for negative, because the assumption behind terminal value, behind calculating terminal value, is that you want to reinvest the project, you want to reinvest the cash flow generated by project. So you can't reinvest negative cash flows. Okay, you can't reinvest negative cash flows. That's why focus is on the positive cash flow. The cash inflow is what you are going to calculate terminal value for. Therefore, when you want to calculate your terminal value, you are just the same way you are calculating your NPV. Let me give you the format to calculate your terminal value. I'm not sure you have it in this material, not there. So when you want to calculate your terminal value, let me come here. Calculating terminal value. Okay, TV. So just the same way you want to calculate your NPV. So I will create column for year, description of items, cash flows. Then instead of discounting factor, you are going to use compounding factor. Let me rewrite that. Compounding factor, then you have the TV, the terminal value. So, of course, for the compounding factor, it is 1 plus R raised to power N. You can say N minus 1. Okay? You can say N minus 1. I will explain what that means. So, when you are calculating your terminal value, you don't have year 0. There's nothing like year 0 when you are calculating terminal value. So what you are doing is to just pick the positive cash flows, which are the cash inflows. Let me use hypothetical numbers. Okay. So this is terminal value. Now, say for example, you have cash inflow of 1,000 for simplicity. In year 2, 2,000. In year 3, 1,500. Now, sorry, I may not even put, there is no even need to, I may decide not to put a description of item. So let's just say cash flows, 1,000, 2,000, then 1,500. Now, say for example, the company, the cost of capital or reinvestment rate is 10%. Say for example, is 10%. Okay. So what I will do here is that, see, remember what I told you, the assumption behind modified internal rate of return is that the cash flow generated by the project can be reinvested at the reinvestment rate or at the cost of capital. So, meaning that these cash flows, all these 3 cash flows generated by the projects, okay, all these 3 cash flows generated by the projects, you want to reinvest it. You want to reinvest it. Therefore, you need to ask yourself, the one in year 1, how many more years can you reinvest the cash flow in year 1? This cash flow of 1,000, you want to reinvest it. Therefore, how many more years can you reinvest it, which is 2 years? Because the year the cash flow occur is out of it. That's end of that year. So year 1 is already gone. So you have year 2 and year 3, meaning that the cash flow of that year 1, you can reinvest it for additional 2 years. Therefore, if I don't want to follow that route, I can say 1.1, because cost of capital is 10%. Therefore, 1.1 raised to power, what's the N is the useful life of the project, which is 3 years. So I can say 3 minus 1, which is raised to power 2. If I don't want to follow that route, I can say, okay, the cash flow of year 1, how many more years can I reinvest it? The year the cash flow occur is out of it. So in this case, the 1,000 can be reinvested additionally for year 2 and year 3. That's why you are seeing raised to power 2. Again, the one of year 2, the cash flow of 2,000 that occurred in year 2, how many more years can I reinvest it? Of course, I only have year 3, which is raised to power 1. The one of 1,500 in year 3, how many more years can I reinvest it? 0. So these are the things you need to take into consideration when you are calculating your terminal value. Like I mentioned to you in this formula that I gave to you, you can just say 1.1 raised to power 3 minus 1, which will give you 1.1 raised to power 2. In the second one, 1.1 raised to power 3 minus 2. 2 years is already gone. Okay, that's the second year. So which is going to be 1.1 raised to power 1. Then in the third year, 1.1 raised to power 3 minus 3, which is equal to 0. So this is what I'm just trying to explain to you. So you start from the compounding factor. You just say 1.1 raised to power 2 equal, multiply by 1,000. Whatever you have, you come and post. 1.1 raised to power 1 equal, multiply by 2,000. You put the number there. 1.1 raised to power 0. Whatever you have, which is going to be 1,500, put the number there, add everything together. That will be your terminal value. Once you have this terminal value, just go and put it in the formula and you are good to go. Okay, so for me now that I've calculated the terminal value, the next stage, because I'm using terminal value method, so the next thing I need to do is to calculate the present value of cash outflow. I need to calculate present value of the cash outflows. So the same format, but only that when you're calculating present value, remember, you need to discount your cash flow. So once I have my terminal value, I also have my present value, then I can go ahead and calculate my modified internal rate of return to say modified internal rate of return equal to terminal value, which is DO, divided by DN raised to power 1 over N or minus 1. So I'll just get my answer. DO is the terminal value. So before I can get the terminal value, I need to come and work it out first using this table. Once I have my terminal value, then I will need to go ahead and calculate my DN is the present value of cash outflow. Present value of cash outflow, because it is possible that your cash outflow may occur more than one period, more than once in the question. In year 0, you have cash outflow. In between the years, you can also have cash outflow. So what is important is that just go ahead and calculate the present value of cash outflows. So once you have that available, come and put it, slot in your formula, you get your answer and you are good to go. So whether you use this formula or you use this same formula, you get, it's the same answer you are going to get. Okay? It's just mathematics. So let me see. No, I don't want to solve illustration on this. Let's talk about, because we have a big illustration we are going to solve for all of these methods. So what about the decision rule? The decision rule for modified internal rate of return is the same thing as decision rule under internal rate of return. So if the modified internal rate of return is higher than the company cost of capital, then the project should be accepted. If not, the project should not be accepted. So it's the same decision rule. So you are going to benchmark your calculated modified internal rate of return with the cost of capital, Okay. So that's that. Yes. Let's see. Let me hear from you, please, before I proceed. Remember, I promised you, so we'll go back to the what we are supposed to do last week. So let me hear from you. Because after modified internal rate of return, we are going to do project duration. Then after project duration, we'll move to non-discounted cash flow, payback period, adjusted the accounting rate of return, accounting rate of return. So, but for now, let me hear from you if you have any question. If not, let's stop here. Let's stop here under capital budgeting. So in our next class, We continue from project duration. We continue from project duration. Okay? Let me stop this.